If you guys know, we've been going in the series of Real Estate Investing 101. The very first portion of the training, we talked about the key is diversification. That's the real key to success. We started diving into what buy, fix, and flips work. And actually a quick update, which I think is awesome because we started the series talking about the principles and implementing the principles, which is really the key for us. We can talk about it all day long, but if you're doing it, that's when things change. And in the presentation, we were talking about a deal we were negotiating to purchase when we first started the series. By the second training, we bought the property that we were talking about in the series. And by the third training, we're under contract officially as of today to resell the property at the end of the series. So again, that's part of the goal, is that if we want to pivot and we want to make changes, we have to implement these strategies. And as a company, it's imperative each and every one of you represent the activation of implementing what we talk about even today, okay? So the rest of this portion of the training today is going to go from the flips. Last week we talked about the key to wholesale, how wholesale is happening, and yet another piece of that is being implemented. We put some new properties in the marketplace. I think Araceli's working on a contract on one of those wholesale properties, so great job with that. I know that right now Javier's working on adding 1 or 2 more deals into the marketplace for this week, and we'll continue to do that. And so again, we've implemented the flip, we're implementing the wholesale, and now of course we're going to talk about another key component, which is very, very important, which is buy, fix, and rent. Now, what's beautiful about rental income or even lending, and which we'll talk about later, the private lending side, the reason why this is so important is because what you're able to do when you own and control an asset and you're able to rent it is that it produces cash flow every month and it becomes more and more passive, which is what we're going to talk about today. And the beauty of building cash flow passively is that over time it frees you up to be able to be more productive. Because if you think about it, why does everybody come to work every day? Aside from the fact that you love seeing my face. And I see everybody smiling, yeah, I love you, but not that much, right? Everybody's here. Why? Because we got to pay our bills, right? We got to make sure that we provide for our families. And that's the number one obligation for most of us, right? We feel this drive. But now imagine being in a place, and I'm not talking 100 properties, or maybe you end up over the next 3 to 5 years building 3 or 4 properties. But those 3 or 4 properties represent enough cash flow to pay your rent or your house mortgage. So just visualize the power of what cash flow would do. Now you're coming to work because you get to stack up money and build up to build wealth. You're not coming here just so that you can survive. And that's the difference that rental income and becoming a passive lender it creates an opportunity. And so again, my goal for each and every one of you is to not only teach you this, but as you help the company get stabilized, then we want to give you the opportunity to also partake and be a part of it, okay? But that only takes a process of discipline, a process of saving, because when it comes to your turn, you need to first have some money in savings to be able to capitalize on those opportunities, okay? So with that said, that's the first thing I want to talk about is the freedom of cash flow. But it is imperative that we go through the basic numbers. Now, some of you that have been with me for a while, you know these numbers. Some of you guys know them inside and out. But you know what I've learned? If you don't repeat, you forget. And so we're going to repeat these numbers. I'm going to try to simplify them to the best of my abilities so that we all learn the power of cash flow. Now, when you're looking at a property for cash flow, a lot of people think, oh, it's a pretty house, cash flow. In fact, I have a guy who's a flipper who just called me the other day, and the same thing. He's like, hey, this property we can pay for almost retail because it doesn't matter because it'll cash flow. But when we started looking at the numbers, they didn't make sense. And so what I want to share with you is one of the key things in rental income, this is both whether it's residential or commercial, is we have to get to the net operating income. Net operating income is a key number in order to determine the value of an asset and in order to really determine if the property is going to be a real cash flow property or not. So the way I'm going to do it today, I'm going to really simplify. When you're looking at an income producing property, whether it's commercial or residential, you typically break it down in this format. It begins with your gross scheduled income. Now, to make it simple, what is gross scheduled income? Well, if I know that I can rent this property for $1,000 a month, then if I look at a 12-month period, can anybody tell me what my annual gross scheduled income would be? $12,000, right? So the gross scheduled income is $10,000. Now, as a real estate investor, we have to anticipate a percentage of vacancy. Now, generally, when you're dealing with a commercial asset, there's multiple units. So that vacancy factor is based on a percentage of those units. So for example, if you have 100 units and 10 of them are vacant on average, your average vacancy rate is going to be 10%, right? But on a single family house, we look at it a little bit differently because obviously when you have a tenant gone, you're 100% vacant. So what we look at in the residential space that's a little bit different is not the average of vacancy. It's literally saying I'm going to allocate a percentage of the monthly or the yearly term, and it's typically 5 to 10%, meaning I'll probably have 1 month out of the 12 months that I'm officially 1 to 2 months vacant while I'm releasing the property, okay? Now, when you take that, and so you take the gross scheduled income less that 5 or 10%, depending on the investor, will give you what we call the gross income. Now we're looking at a gross income, and that income is what you're bringing in, but just as it says, is gross. Gross is gross, right? It doesn't mean that's what you take home. And I love hearing investors that come to us and tell us how the property cash flows, but they're basing it on gross income. And guess what? There's expenses, right? As we all know, Darla, right? You get to cut those checks. There are expenses to run cash flow properties. So what does that look like? So once you've established your gross income, then you're going to take away what we call operating expenses. Now, I'm going to make a point here at the end of this, but I want us to look at the basics. Operating expenses are just that, operating expenses for the property, which would be what? Property management, property taxes, property maintenance reserves, and property insurance. Basically, any cost that is associated with running the operation of the rental property falls under the category of operating expense. So when you take your gross income and you take away all the operating expense, you arrive at your net operating income. Now, if you're dealing with investment properties, in the multifamily space, generally they put about 40 to 45% as a buffer for all of their operating expenses. On the residential property side, generally a rule of thumb would be that we look at about 30% of the income goes back towards the operating expense. Okay, so that's generally a rule of thumb. It doesn't mean it's exact, but on average, you could be looking at 30 to 35% in order to get to that. Now, once you arrive at the net operating income, that income is what ultimately you're going to use to value the property and to determine if there's a debt service coverage ratio. But before I go into that, I want to give you another component. This is really important for us to understand because a lot of investors make this mistake, and it's a rookie mistake. And that is, a lot of people say, well, Rick, you're missing a number here. What you're missing is the mortgage payment. Because if you're borrowing money, would you agree that should be an expense? But that's a finance expense. In the commercial and rental space, you never add the mortgage cost to the operating cost because you're always assuming you bought the property with cash. That's the way you get to determine the value of an asset. So we separate that. So really, technically, once you have your net operating income, you take out the mortgage, or what they call in the actual commercial space, debt service. So you would say then net operating income less annualized mortgage equals your cash flow before taxes. So that's how you arrive at cash flow. So when you hear an investor saying the property cash flows, it has to be cash flowing after you pay the mortgage. But mortgage is separate from the operating expenses. Does that make sense? I just want to make sure to make that clear. So when you're looking at a real estate deal and you're working with a client that's talking about a rental property, if they're telling you the property cash flows, but they're referencing gross income, you know they have no idea what's going on, right? That's the reason why this is so important for all of us. Now, with these particular formulas put together, which is very simple, gross scheduled income less vacancy equals gross income. Gross income less operating expenses equals net operating income. Net operating income minus the mortgage equals cash flow before taxes. Do you see how simple that is? But when you start speaking term and jargon, people are like, I have no idea what you just said. This is like Chinese, right? But again, it's fully understanding the flow of an expense, income versus expense. So now, the rule of thumb that I'm going to talk about here is specifically how do we value a property? And this is a rule of thumb, but you have to first have this information to be able to make that determination. Okay, so once you have NOI, then you can use what I call the IRV formula. The IRV formula is really just that. It's a rule of thumb to help us to identify either the value, the rate of return you're making, or the income that you need to be in order to do that. So what I want you to look in the IRV formula, I'm going to move this camera here if you guys can. All right, so there we go. All right, so briefly here, what I want to show you guys is a simplified version of EARTH. I make it into a circle. R, V, I. It's as simple as that. For everyone that's looking over here, it's I, R, and V. Now, what's really cool about this formula is that once you know the net operating income, you can very quickly determine the value in seconds on a property without having to spend hours and hours trying to figure out what to do. Or you ask Javier, he'll put it in the software and it spits it out, right? But it's important for you guys to know the rule of thumb. So let me give you an example. If this represents a net operating income, it goes as simple as this. Let's say that a property is producing annually $100,000 in income. That's your income. Okay? Now let's say that I want to make a 10% return on my money. So the rate, or the R, is going to represent 10%. Okay? So if you take that 100,000 divided by 10%, what does it equal? It equals 1 million, which equals your value. So what you are able to do here is you can take the I divided by the R will always equal what the value should be. Or you can reverse it. So now some of you guys don't know what your return is, but you know that your seller has picked a number of how they want to sell the property. So let me give you another example. The same formula, if you know the property is producing a net operating income of $100,000 and the guy is selling it for 1 million, what is the return? 10%. So you would take your income divided by the sales price and it'll tell you a percent of what your return is. So the income is always divided by either the rate of return you want to make or by the sales price, and it will always answer the other side. But here's what's really cool about the EARTH formula that I like. If you don't have this number, but you want to make a specific return, you can literally take the return multiplied by the price or the value, and it will tell you what income needs to be. And that's what's beautiful about this formula. That's why I use it so much. Because in seconds, I can say, well, if I want to make a 10% return on my $1 million investment, which is the price you're asking for, then the property must be producing $100,000 a year, because when I take $1 million times 10% equals 100,000. Does that make sense for everybody? So this is a very simple formula that allows us to be able to determine if this investment is going to make sense within a couple of seconds. Now, in the residential space, it gets a little complicated because when you look at these properties, and this is why I want to teach this to you, you'll have a client who says, this is a great deal, but when you run the formula, you're at a 5% cap rate. And you're sitting here trying to shove a deal down our throat to close a deal because you're like, hey, it's a rental property. But let me ask you a question. If the rental income is only representing a 5% return on the money, what happens when you have to borrow money at 9%? There's no cash flow, you're negative. And so it's imperative in a rule of thumb, if you have a client giving you a deal and you look at the deal and you say, wait a minute, if you bought this cash, you'd make a 5% return. How is this a good deal for you? Because if I give you a loan that costs more, you're in the hole. You guys follow what I'm saying? And so that's why it's so important for us to get these basic numbers, because in 2 seconds, you can know this is a great rental property, or you know what? This is not going to go. Everybody with me so far? So this is the power of the EARTH formula that you could use in seconds to analyze your investments. And it'll help us to really determine if it's a good deal. Now, some of you, and I'll come back in a minute. All right, so some of these investors will use that EARTH formula to really determine, again, in a cool couple of minutes here, if it's worth being a landlord at those numbers, right? And some of you guys are going to have to take it one step further because we're a lender and everybody wants to know, hey, what are the terms you're going to offer me? Now, there are other terms that we use for this space, but now that you understand the EARTH formula, I want to show you another formula that's really important. And that EARTH formula transitions into what we call your debt service coverage ratio. Now, there are other institutions that will actually call it the PDTI, which is another fancy word for your basically payment debt to income ratio, basically is what it comes down to. But what I say is keep it simple, because if the debt service coverage ratio works, guess what? It'll probably work in your PDTI too, right? And so it's more important if you want to be quick, because we don't have time to sit there all day long and spend 3 hours on a deal. You have to very quickly analyze those numbers to make a determination. So here is what the debt service coverage ratio, it really means. and I just want you to write this down because this is really simple. $1.25 of income to $1 in expense. I'll say it again, $1.25 of income to $1 in expense. So what am I saying when I say that? What I'm saying is that for every $1.25 of income that you bring in, you should not exceed $1 in mortgage payment out. That means that you need to have about a 25% ratio for every investment that you're doing in cash flow so that you're not over leveraged. Okay, because there's going to be months there's no payment, right? And so you need to make sure that is going to make you a profit. So how do you calculate that? It is very simple. You take your net operating income, you divide it by the annual debt service, and it equals what? It equals your debt service coverage ratio. That is a very simple calculation. So again, I'll say it. Your NOI divided by your annual debt service equals your debt service coverage ratio. 1.25 is the magic number. Anything above that is healthy. Anything below 1.25, then you need to start asking yourself, why are we doing this deal? Especially in this market, you want to be making sure that your investor's making money. Because if they're not making money, what's going to happen is they're going to become our property manager for free. And at some point, they're going to walk away from the deal and it becomes a loss for them because they weren't measuring whether it was good to be a landlord or was worth it in that specific deal. That's why this is so important. So let me give you an example. We talked about a building that is producing $100,000, right? Yes. So we're looking at a building that's producing $100,000 in net operating income. The purchase price of the building is $1 million. The rate or the cap rate is at 10%. So how do we determine what the actual debt service coverage ratio is? It is very simple. So let's say that we get a mortgage on this deal, just to keep it simple. It's $1 million purchase, and let's say his capital is going to give you a loan for $800,000. So you're putting $200,000 down. So what you would do is you would take the $800,000 and you would basically multiply it by the interest rate that is being charged. So let's say in this case, we're going to do 11%. Okay, so we have 800 times 0.08, which is 8%. That is $64,000 a year in debt service. That's in your mortgage payment. Is it? Oh, yeah. Oh, yeah, thank you, thank you. No, that was my bad. 88,000, thank you for that. Yeah, so I'm just throwing at 11%. I'm so used to calculating at 10 or 8, I'm sorry. So let's say that we have that $1 million building, the investor puts $200,000 down, and then $800,000 is financed. If we finance that loan at 11%, that means that $800,000 is going to cost $88,000 a year in order for the money that is, you're basically renting money if you look at it from that perspective, right? So what we would do in this formula is we would say, okay, well, we're making $100,000 a year. So it's 100,000 divided by, what did I say the debt service was? 88,000. And that gives me a 1.13%. Is that a good deal? If you think about it, a 1.13% means that you're making only 13 cents on every dollar that you pay out in mortgage payment. Is that a good deal? No. So there's only two ways for this deal to make sense. A, we lower the interest rate, or B, we lower the price. But somewhere in the middle, something has to give, right? So now let's say we're at 9%, just to give you an example of how the rates will vary depending on the deal. We take that same $100,000 divided by, now let's say we're going to do 800,000. And let's say we're at 9. Actually, let's do it this way. Hold on. That is $72,000. So we take 100,000 divided by 72,000. It equals 1.38. Does that make more sense? So you see the difference in the rate. If we were in the 9s, this deal would make sense. But if we're not, then it makes a massive impact on our cash flow. And so again, when you're doing lending on a deal, you have to always ask yourself, do we have a better program for them to lower their actual interest? Or do we go for helping them to negotiate the price? Because we recognize that they can't get financing anywhere else. So that means your only option is to negotiate a better price so that you have more room to produce the cash flow. Does everybody follow what I'm saying there? So again, The rule of thumb of Earth formula and the debt service coverage ratio are your best friends when you're looking at a rental property. And really, those numbers will tell us if it is worth being a landlord on that deal. Because remember, not every deal is the same. And so hopefully this helps you guys to get a better picture. Now, with that said, I'm also going to give you a couple of keys to successful rentals and being a landlord, okay? There's so much that could be covered in this and so many mistakes that I have made, and sometimes I'm still making mistakes right now. And a lot of times is, you'll see in a minute what they come down to, but they really boil down to 3 key things. First one is having the right team is the key. Beginning with, you need to find the best property manager. You will be amazed, honestly, of how deals can become either successful or cost you money simply because you have the wrong property manager in place. This way. You're saying, so just to bring the question real quick before we proceed, what you're asking is, what is a good return on investment? A good return on investment is anything over 1.25 on your debt service coverage ratio. If I'm buying right now, which we are, I'm not going to buy a property that has an 8% cap rate in the market. I don't care. Because I don't care what anybody's buying. What I care about is, am I buying right? And that's what we need to do to educate our clients. Because some clients are like, yeah, I'll buy it at an 8 cap. But then when they want to refinance, they can't. So their money's stuck on that project. So for me, it's all about looking at least a 12% cap rate. I only go below 12 if I have a substantial amount of equity in the property, and within 2 years, I can sell it like a flip. So if I buy a flip that's got a lot of equity, then it's okay if I take a lesser cash flow, because this is going to be for a short period of time. And my real exit strategy is to sell it and cash out. In commercial is the same way, correct? In commercial, you're looking at the same cash flow to really determine. In fact, commercial is even more strict because it's not that it's a good investment. It's unless if you have cheap capital. I mean, look at an investment. If you look at an insurance company can buy a AAA apartment complex at a 3% cap rate, which to me is absurd, but their cost of capital is 1. 10 years from now, that building is worth 15% more. Yeah, it makes sense for them. So it's all based on the strategy and your cost of capital. That really is what determines whether or not you're going to do it. So, but in my side, we want to make sure we have a high yield because our cost of capital is higher. You know what I mean? Now, if you want this investment to be successful, these are the key 3 things. Having the right team is key. You want to have a good attorney. You want to have a good insurance agent. You're going to look for a team that's involved. Typically, if you hire the right property manager in that area, that property manager already has a team, and you can just leverage them. We have a guy right now in Pasco that we're working with. There's some things I don't like about him, but the reality is he's a go-getter. For years, he has managed our properties, and he has a knack for doing something that I'm going to talk about next, which he has a process for the next step here, which is vetting the tenants. And if you really want a successful investment, it comes down to who's making your payments, right? So if you have the right property management team member in place, then it goes back to making sure that right property manager is vetting the tenants, because that is essential. So how do we do? We make sure they fully vetted the tenant, make sure they have income, their credits within guidelines, that there's a background check, and that we verify rent history. That's what a good property manager will do. The next thing that a good property manager will do is to negotiate the highest and most amount of deposits. Why? Because they're looking for skin in the game. I have honestly been amazed in markets that I have talked to in the Tampa Bay area that are more affordable income. I've had other property managers tell me, it's just, you don't understand, Rick. These people don't have money. They can only afford this. I usually run away from property managers that tell me that sob story, because my property manager in that area, the same area people would say, oh, it's just affordable, will give me $3,000, $4,000 sometimes on a property because he knows how to sell. So guess what? When those people put that kind of money, they're less likely to walk away from the deal because they're more committed to that home. And that's one of the things we look for. Now, I'm honestly a soft person when it comes to that. Somebody gives me a sob story and all of a sudden it becomes ministry, and before you know it, instead of a cash flow property, it's a nonprofit organization, right? Why? Because you feel bad, you want to help people. But a good property manager is going to make sure they have skin in the game, and they're going to make sure, and here's another piece that I would recommend, they require renter insurance. Because you have to understand that even though as a lender, we require a specific tenant occupied insurance coverage, that insurance policy does not cover any of their stuff. So if God forbid there's a flood or there's a storm or there's a fire, it is not going to cover all the stuff that your tenant has in the property. So one of the things that our property manager will always do is say it is required for you to have the actual renter's insurance. Now understand that at any time they could cancel. It is not my job to enforce that. My job is to say it is a requirement and you bound it in the lease. If you don't want to pay that and the house burns down and your stuff is lost, that's on you, because we have an agreement where we told you it is required for you to have insurance. You breached the agreement. Does that make sense? So again, it's not my job to now start chasing people and give me proof of your insurance again. Hey, you signed it. We required it at entering into the lease. If something goes wrong after this because you didn't pay it, that's on you, right? So that's why that's so important. And make sure that everything is in writing, which is another really important piece, that you have all those documents. And then lastly is technology is working smart. If you're going to grow in cash flow, if you're going to run, put it this way, let's say some of you guys are working here and you buy a rental property and you're excited because you got a rental property. Does the rental property run your schedule? And if it is, then it's not a rental property anymore. It's not cash flow. You're working for your investment, which is again why it is so important to get a good property manager that vets your tenants. But also the other key thing is making sure that the software is working. In fact, we're integrating a new software. So part of what we're pushing as hard as we can is everybody use the software so that we can pull the rental report, so that we can understand the accounting behind the property and know where our expenses are, so that we can track documentation and the things that are going on with your property. And sometimes that can become a job if you don't have it with technology. But with technology, the one we're using right now is AppFolio. All of that is incorporated within it. So again, it's imperative, guys, that if you're going to build cash flow, it's imperative that we're going to lend money to people building cash flow, that the numbers make sense and that these three key pieces are in place. And as a salesperson, if you're selling a loan, this is the perfect time to take this information and educate your client and ultimately say, hey, so who's the right property manager for your property? Who's going to do it? Because if not, this could be an issue. What is your vetting process for these tenants? I'm not doing this because as a lender I need it. I'm doing this because I want to make sure that when you lend the money and you close, you're going to have a property that's going to pay our mortgage and pay you cash flow. And so all of a sudden, before you know it, this creates that credibility that you need, that edges you all over all the lenders who never talk about this. What do they talk about? PDTI, that's it. But if you educate your customer, now they want to work with you, they trust you, and they have a lot of respect for you for that. Lastly, I'll finish it with this quote. Real estate cannot be lost or stolen, nor can it be carried away. Purchase with common sense, paid for in full, and managed with reasonable care. It is about the safest investment in the world. Franklin Roosevelt. Now, there's some key things that I want to highlight here, guys. We are in an industry that has, I believe, one of the best investments in the world. But the real goal, even though we're lending money, is for investors to buy their real estate with common sense. Some of the common sense that we just talked about today, right? Paid in full means you get it to the point where it's free and clear. Now, if you're going to grow in this business, it's not always going to be the case. We'd be out of business. But our goal is, if you bought it with common sense and you have discipline, is that you let your tenants pay your house in full. And as long as you have the property with reasonable management and taking care of the property, it will literally become the safest investment in the world. But it flips to the opposite. A real estate investment purchased without common sense, without using the guidelines, leveraged to the hilt, and improperly managed brings a disaster. And that's the problem that most of our investors are missing. And so it is our job to empower our clients to give them the right perspective so that when they're buying, they're using the right fundamentals, they're borrowing safely without getting over leveraged. And lastly, they're managing their investments so that it can produce a safe return on their money. So with that said, guys, I'll open it up to any Q&A and then we'll wrap up for the day. So comments, questions, anybody?
I was just going to say that those of you that originate loans have the latest tool, which calculates both PDTI and the debt service cover ratio. So make sure that you guys run both, even though we know that for now, and this is just for now, we're basing it for lending on the PDTI calculation. So just keep that in mind, guys.
And that's the tool he's referencing, guys. I think you guys have it all. And it'll calculate it all for you. Yeah, when you're doing a rental property, yes. Skin in the game is security deposit, collecting first, last. it depends on how solid, of course, the tenant is. And you want to have balance, but I don't want that burden. I'd rather let my property manager handle that, let him sell and earn his keep. And a lot of times that's a part of what determines if he's good or not. And part of why do you think he's doing that? Because if he's a good manager, he's doing exactly the same thing. I make more money if this guy doesn't bother me. So I'm going to make sure that I work hard now to get the right tenant so that he doesn't bother me for the rest of the term. And I'm just collecting cash flow. And so that's a part of why that's so important. Anybody else come? And Monique, you're going to say something about it? Or? Yes, as well. Yep, you're right. Good point. So if you're having a house that's in Reunion Resort and there's an HOA or a condo, obviously that's a part of operating expenses. That's a maintenance cost in essence, because you're basically paying them to maintain from the walls out of the community. So good point. Anyone else? Comment, questions, concerns? Anybody found this valuable? Okay. So it's a refresher. Let's keep learning. Let's keep growing. And let's use this as a tool to educate our customers. And also, let's get ready so that as you're saving money, I want to hear that it's you with your rental property. I want to hear that it's each and every one of us. But we got to get to that step first. Awesome, guys. Well, thank you so much for your time. We'll wrap it up and let you guys get to work. Let's go make this week productive.